Hi everyone, welcome to another video of what's moving the markets. So we've been going through a period of high interest rates, and finally it looks like inflation is starting to cool down, and we might see the Federal Reserve pivot, which means from increasing interest rates they go to decreasing interest rates. So that, of course, is one component. And then we've got our geopolitical issues happening in the Middle Eastern region. In the Northern African region, also, there is turbulence. So we're going to be looking at all of these global forces that are at play and how they are creating a turbulence in the market. And then we'll be doing a deeper dive into the different sectors, that what's happening sector wise, right? In terms of, is there a rotation going on? Is tech going through some troubles? Is tech coming down? Which sectors are going up? How this rotation is happening? So we will be going through all of this. As always, of course, this is a casual video series. So for your investment decisions, please consult with investment professionals and do your due diligence properly before taking any action. This is not investment advice. All right, so what's going on? Let's start at the global level, then we will drill down into the company level. So clearly, there's a lot of uncertainty that is there. It's both geopolitical in nature and also economic uncertainty. Now, most of you will understand what the geopolitical tensions are. The economic uncertainties are a little more delicate to understand. That has inflation really peaked, right? Has the Fed now definitely decided that they are going to start decreasing the interest rate in a big way? And the answer to that is no, because due to these geopolitical tensions that have been going on and the militarization of the entire Middle Eastern region, which then leads to higher oil prices because the conflicts disrupt oil production, which then again adds back to the inflation. So until inflation doesn't really go down, you can't be clear on the economic front. So there's still economic uncertainties. All eyes are on inflation. But as long as this geopolitical issue is there, it's not conclusive that whether the inflation is finally going to calm down or not. Plus, another very interesting thing is your green investments. So, of course, as a world, we have a climate change issue going on. And because of that, we need to move towards green energy, but green energy is very capital intensive, whether it's a wind farm or a solar farm. I mean, you have to do a huge capital intensive investment first, and then your return comes over a number of years. So again, to do those capital investments you need money, so there's probably going to be uh, money printing which will continue, which of course is going to then have a positive impact on inflation. So even though you see that inflation is finally cooling down and these things have taken a center stage, but it's not so simple, right? There is a complex interplay of various factors going on. Uh, Another very interesting factor which is coming into this mix is the demand recovery in China. So as China demand picks up again, so the demand for copper, for instance, is picking up. So copper is going up, and that again is going to add to the inflation. So where on one hand we are seeing that inflation is cooling down, and that should lead to a lower interest rate, right? The chairman of the Federal Reserve was very clear in the recent meeting at Jackson Hole that finally the time has come that we can start, pivoting. But if that was the case, then why is the dollar going up for the past couple of days, right? It should theoretically weaken the dollar. And what's the theory behind this? When the US lowers interest rates, people who are saving in dollars, right? Let's say I'm a British investor. I've changed my pounds, my British pounds into US dollars because I'm enjoying the high interest rate. But if that interest rate is going down, well, I would want to then sell my dollars and move back to the pound, or maybe move into gold, right? So theoretically, if what was said at the Jackson Hole Economic Symposium, that the Fed is finally now going to pivot. Well, if that was true, or it was true to a great level of intensity, which would mean that there would be a huge expectation of lower interest rates, that should theoretically weaken the dollar and boost the gold. But we are not seeing that. Gold hasn't gone up this past week, and dollar hasn't gone down, rather it has gone up. So that means in this complex interplay of factors, it's the geopolitical tensions which are taking a more center stage, and it's not clear on an economic front. There is still economic uncertainty whether inflation is really going to cool down, right? And as I will show you later on, when we zoom into the different sectors, that financials has been doing good. Now, why are banks doing good? Because the interest rates are high and the market expects them to stay high. So even if the Federal Reserve is going to reduce the interest rates, it's not going to be that much, which means the differential in the interest income and in the interest expense, or rather just the net interest margin that banks earn, will continue to stay fat, right? Plus their non-interest income is growing as well. So that seems to be doing well. The financial sector has done quite well this past week. So this is the whole complex interplay that is going on, that yes, on one hand inflation is cooling down, but it's the geopolitical tensions which are taking center stage. And because of that, it is driving a demand for the US dollar. Yes, gold has been going up over these past number of weeks and months, but I'm talking about the recent context where at the Jackson Hole Symposium, it was discussed that finally we are looking at a pivot, but that is not being seen in the dollar index and the gold. What is being seen is that there is more demand for the dollar as a safe haven. There is still demand for US treasuries, short term, short maturity, money market, right? Because obviously, long term, we might see a different situation, but in the short term, we still see a huge demand for the US dollar as a safe haven, and this is sort of muting the rise of gold. So that doesn't mean that gold is not a good investment. Gold is a super amazing investment, right? It is also a safe haven. But the demand, because gold is priced in dollar, so the demand for the dollar going up mutes the rise of gold, which is a wonderful opportunity for traders. So if you trade gold in dollars, then this volatility is fantastic, right? Because you can buy when it comes down, you can sell when it goes up. So definitely a good idea to keep gold in the portfolio, and also keep oil and copper, because like we discussed, the Chinese demand is coming back, so copper is really getting a strength from there. And oil, because of these geopolitical tensions, is going high because production is getting disrupted. So you could maybe take some exposure in gold mining stocks, in copper mining stocks, in uh, oil producing companies. Again, not investment advice, but just to bring this together into what we're discussing, that because of these geopolitical tensions on one hand, and because of your Chinese demand coming back, right, gold, copper, and oil seem to be interesting components that you can have in your portfolio. And of course, all of this should ideally be in the New York Stock Exchange dollar backed stocks. So, for example, gold miners like NEM, and Barrick Gold, which also does copper. NEM also does copper. You can look into energy companies again based on the New York Stock Exchange or Northern American stock exchanges. Those could be interesting options for you to look into. But this is a trading market, right? So as they go up, you can sell a bit. As they come down, you can buy a bit, because this complex interplay of factors is creating this turbulence, which as a trader you can benefit from. Right. So now let's talk about the rotation that's going on. Now, this is a relative rotation graph. It is a proprietary tool. So I can't go into much detail about it. But what I can do is tell you how to read it for those of you who don't know how to read it. And somebody taught me, and I would like to pass that on to you. So it's a very nice way of looking at it that I learned from someone, and I would like you to learn that from me. Is that think of the market as a big truck going on the highway, and some cars are ahead of the truck and some cars are behind the truck. Now in those some cars, the ones which are ahead and are still going faster than the truck, they're still accelerating faster than the truck, then they're in the leading segment, which is stocks that you want to have, right? Because and the truck being the market, so you want to outperform the market, right? You want to outperform the market, which means your investment should be in those cars which are not only ahead of the truck but are speeding up, accelerating even more, so they will continue to be more ahead of the truck. Now the weakening quadrant is one where they are currently ahead of the truck, but they are falling down in their speed, which means soon they're going to fall behind the truck, right? So, this is the key thing that you should take away from today. And what is this? This is the NASDAQ composite, right? Which is your tech stocks. Your tech stocks have fallen from the leading quadrant to the weakening quadrant, which means they are still ahead of the market. They've done very well over these past few months, but they are now slower than the market. The market is going to probably do better than tech stocks, and tech stocks might fall into the lagging quadrant, which means these cars are the ones behind the truck now. So they are lagging, right? Now these ones are the real interesting ones. These are the ones which are currently behind the truck, but they are catching up, right? They are catching up, and very soon they might overtake the truck. So this is the one where you want to position your portfolios in terms of the sectors. Now what is this? Industrials, Hindu, right? And another one which I think we're going to get into more detail later on, that what is inside these stocks, what is inside these stocks, New York Stock Exchange Composite Index and TSX and Amex and Dow Jones Industrial Average, that which sectors inside the overall um, better performing, better improving uh, sectors, like within those major industrial averages, what is inside them, right? And which we can focus on and really understand why they're doing well. So when we pick out our securities, we make sure that those themes are valid for those securities. Right. So the industrial average has been going up, whereas your S&P has been flat. The reason for that is it's heavily weighted by technology stocks. So even though the other stocks are going up, so there are gains in some sectors, but because there are losses in technology, so S&P has been flat, right? And in the next slide, I'm going to jump into the different sectors and show you exactly what's going on. Of course, we have already discussed this, and I will keep emphasizing on this, that the real expectation that is going to be possibly either confirmed or the reality might be different is what would be the data for inflation this coming month, right? So if it really cools down, then we might have a different sort of situation in the market. But right now, by the look of what's happening in terms of the prices of these stocks and these sectors, it doesn't look like the market is really expecting inflation to cool down in a big way, which means they're not expecting the Fed to go for some big cuts, right? And why am I saying that? Number one, financials, right? They are benefiting from the higher interest rates. And if the market thought that, hey, inflation is cooling down, the interest rates are going to come down in a big, fast way, well, the financial sector wouldn't be doing so well, right? Because the market is forward looking, which means this increase in the financial sector is not because of the wonderful results that they've posted now this time around, and they have, by the way. Most financials have really outperformed their expectations, both in terms of interest income and non-interest income. But the market is forward looking, so the market not only likes what they're seeing right now in their results, but the market feels that this higher interest rate will continue for a while, which means this fat net interest margin will continue. And overall, they feel that this geopolitical uncertainty will continue. So you see that utilities and healthcare, which are defensive sectors, they seem to be doing well, right? So what we are seeing is that your energy, because of higher oil prices, because of the geopolitical issues and the militarization of the Middle East, so they feel that inflation will stay up, and your financial sector will continue to benefit. Industrials are going up, materials are going up, defensive rotation is happening into defensive, and what's taking the hit? Your technology is taking the hit, right? So tech stocks have been under pressure due to high valuations and unmet expectations. Now, what does that mean, unmet expectations? Let's do a deeper dive into one of those stocks and see what exactly has been unmet. See, if you look at Nvidia results, they are fantastic, right? Impressive year on year growth. And in terms of expectation, the result is better than expectation. So then where is that gap in terms of expectations? What was the market expecting and what did they not deliver? If their returns in terms of revenue growth, income, profitability, results is more than what the market was expecting, then where have they disappointed? Well, they've disappointed in terms of forward guidance, in terms of how much they think they will grow in the future, right? And that's why the drop is there, because the market was not only expecting fantastic results this time around, which they have delivered, but the market was expecting that this growth will continue, on which they have said, no, we don't think this type of growth is going to continue, right? So that's where the difference is in terms of expectation and reality, and that's where the drop is coming from. All right. So, what's the outlook? Well, like I was telling you, we are, on one hand, theoretically expecting that inflation should cool down, and the Federal Reserve chair at the Jackson Hole Symposium has said that time it's like looks like the time has come for the Fed to start reducing the interest rates, but the market doesn't seem to be convinced, right? They probably feel that the geopolitical risks are much more significant, right? Which will not only play a role in terms of oil price staying high, which will definitely contribute to the higher inflation, but also the Chinese demand recovery, furthermore, hiking commodity prices like copper, etc. And then, because all of this will happen, plus the green investments that have to be done, again, requires a lot more money printing and capital intensive investments. So it looks like inflation, the market doesn't feel it's going to come down that fast, and the interest rates are not going to be reduced that fast. But let's see as we move into September. Today is the 1st of September. So let's see what happens over this month, and what the upcoming CPI and PPI data is going to be like. So that's going to be very interesting to see. So, in conclusion, this past week, we saw a mix of global economic factors. We saw some high stakes earnings reports. We saw some sector specific trends. So, overall, a very interesting week. Stay tuned, right? Let's see what happens in the coming few weeks. And of course, if you found this useful, please like, share, and subscribe. And if you have any comments or questions, please leave them in the comment section below. We would love to interact with you. And thanks for tuning in, and we will see you next week.